Hello, everybody. Luke Gromen, FFTT. Hope you had a great weekend. To know the weather here in Northeast Ohio was very nice again. It's probably been the mildest winter we've had in, I don't even know, long time. So, at any rate, we're definitely grateful for it. I'm going to jump right in. So thanks as always for joining us. First off, from C. I read an interesting thread by TED Talks Macro explaining how China and Japan are injecting liquidity in excess of the QT by the Fed. Could this make risk assets way less sensitive to QT than expected? Could this be the reason why the consensus bear market view has been wrong? The short answer is yes. We've been highlighting a version of this that's been written about by former Fed official Kathleen Tyson. She's referred to it as daisy chain, which is foreign central banks effectively QEing each other's debt, basically to ensure global liquidity levels. It seems to have begun in the immediate aftermath of the mid-October IMF meeting in Washington, D.C. last year. We wrote about that at the time, wrote a bit more about it earlier this year. There was a lot of conversation around the dollar. Attendees were saying they were not happy with how strong it was. It was putting stress on them. It's putting stress on global sovereign debt markets. So absolutely, the $64,000 question, really, how long will it continue? Ultimately, our view is that it is essential to the United States interests to keep the U.S. dollar moving down now. If you've noticed, one of the nice side effects of the weaker dollar since October has been very good Treasury auctions, particularly over the last month and a half. There have been some comments on Twitter lately saying, hey, look how good these auctions are. There's no problem. Well, yeah, there's no problem because the dollar fell 12% in a quarter. You take that dollar back up, you're going to go right back to where we were in third quarter last year when you had the dollar up 10-12% in a quarter, which is you had horrible Treasury auctions. So it's very much in the U.S. interest and the Treasury's interest, particularly in a debt ceiling year where things are getting a little hairy, or may get a little hairy as it is, particularly given what's happening with the deficit, which is blowing out in part due to the increase in interest rates. So this daisy chain metric, this daisy chain QEing of each other's debt, so to speak, is a way it could be managed. I think it'll continue to be managed just again because it's a matter of national security for the U.S. to keep the dollar moving down at this point. Secondly, from JD, how does the U.S. afford its sovereign debt payment at a terminal Fed funds rate of 6%? It would be a circa $1.8 trillion interest payment alone on a pro forma basis on, call it, $31 trillion in debt. If it would take you to the number one line in the federal budget from the fourth line in 2019, is the talk of 6% just fantasy, or do they totally slash spending Medicare and welfare? In my opinion, this is the most important question that very few people are asking or thinking about yet. At this point, right now, we're still in this sort of phase where most analysts, policymakers, are they see a hot inflation number, we sort of recite almost religiously, well, Fed's just gonna have to raise more. Oops, hot inflation, good jobs, good ISM, good, Fed's just gonna have to raise more. It's like an incantation in church from when I was a kid. Nobody's doing the math yet. I think more people are gonna start doing the math though in coming months. 6% is $1.8 trillion pro forma. That would be about 38% of all-time record tax receipts would 1.8 trillion. And tax receipts are already falling, and those tax receipts are heavily dependent on asset prices. So my understanding, and if I recall correctly, and I could be recalling incorrectly, so take this with a block of salt, but if I recall correctly, once you get interest expense above 40% of tax receipts in highly levered emerging market sovereign debt situations, you start to have conditions for a real crisis, for a real currency crisis, a balance of payments crisis, which again in the United States would look like what we've talked about before. Either the dollar goes down and then we get high liquidity, high inflation, etc., or if the dollar's going up, we get dollar up, everything else down until either the system collapses or the dollar is brought down by the Fed, by Treasury, etc. 1.8 trillion in pro forma interest would be the U.S. government increasing deficits to pay interest. I'm assuming they would not slash defense spending. I'm assuming they would not slash entitlement spending because that would just increase the deficit on countercyclical spending. So you're basically talking about interest turning into a fiscal stimulus package of sorts, which is a really weird way to think about it. So you could see it just starts to spin on itself. So I think once more investors start just asking this question, there's really, again, it's this religious incantation of, well, the Fed's just going to have to do more. I don't think we're that far from someone going, hey, sort of the little boy looking at the naked emperor going, can they afford 6%? Can they afford to keep going? I think once that question starts being asked and thought about with a little more rigor, I think it's going to be really good for gold. I think it's going to be really good for Bitcoin. I think it's going to be really good for commodities. I think it's probably good for stocks, broadly speaking. Okay, next question from SE. Given the two stark outcomes that lie ahead of us, depression or face-peeling inflation, per a tweet I put out the other day that I'd point people toward, and given that so much depends on which we get, how do we, as early as possible, discern which? I mean, there's a ton writing on this. How to construct a DIY depression versus inflation meter. And then in a related question, I'm going to answer them both because they're related, from SP. You recently stated a base case is either a melt up or off the cliff. What is the probability we get one or both in 2023, and what signs should investors look for over the coming months? I think it's going to be really important to take a step back. I think first off, watch the dollar. Okay, if dollar's going up, bad things are going to happen. If it's going down, good things are going to happen. That's sort of a very oversimplified way of looking at it. I do think, though, for the vast majority of investors, what appears to be coming at an accelerating pace is likely to be untradeable, in my opinion. We saw volatility in FX and in sovereign debt at levels pretty much no one in their careers had ever seen last year. It could get more pronounced. I expect it to get more pronounced in coming quarters and over the next couple years. And as such, I think the way most investors should approach this, unleveraged, diversified, with sort of a barbell approach is how I'm personally doing. I've got cash, short-term treasuries that I'm overweight, and I've got gold, Bitcoin, industrial commodities, energy commodities, or industrial equities and energy-related commodities that I'm overweight. We're not trying to get rich here through this. No one alive has ever seen or lived or traded through this. And so we're in uncharted territory. We're just trying to survive here. So if we can make a little money, great. But it's about surviving because I expect the volatility in areas we've really never seen volatility. We've never lived through before. FX volatility, reserve currency volatility, sovereign debt volatility. No one alive trading has ever seen treasuries sell off more than stocks. It happened last year by a lot. That's exactly the kind of thing I mean and expect. The one thing I do feel strongly about is I'm allergic to duration, longer dated bonds. Yes, they can work. Yes, they have worked year to date. To me, it's picking up nickels in front of a steamroller for the average investor. Leverage and concentration in positions, in my view, you're taking unnecessary risks. So continue to have high conviction in the end game, which is significant inflation for a sustained period of time. But we just don't know the path, and with what's happening politically, geopolitically, energy-wise, in my opinion, it's important to have that unlevered, diversified sort of barbell approach. In my case, to make sure we get through, to make sure we don't get carried out. I think that's the most important thing. It's just such a unique time. Next question, SB, major assumptions you think about when assessing rising costs of Medicare. My big item is that demographic changes are going to increase cost of care growth rates, and current actuarial models may not reflect it sufficiently. I tend to look at it simplistically as a generalist, it being these entitlement costs. So I look at how fast it's been growing on trend. I make some assumptions relative to cost of living adjustments, COLA. So that's publicly available, right? I make some assumptions around enrollment, just given demographics. I don't get into a lot of details with the actuarials, etc. I am using 12% overall entitlement growth spending for 2023. I don't think that's incredibly aggressive, given a nearly 10% COLA rider in Social Security alone. Some enrollment on top of it. Health and Human Services historically has been 6 to 9% CAGR. That's up in part due to some of the increased costs around COVID, etc. Bigger picture, I think it's really important to take a step back and really understand the key takeaway from the entitlement side that we've been talking about, which is $2.9, $3 trillion a year cash out, effectively an interest expense line item to float the $100 trillion plus in off-balance sheet obligations of these entitlements. And critically, it's important to understand it's effectively debt in a foreign currency. It's common to say, well, the U.S. can't have a balance of payments problem. It owes all its debt in its own currency. And nominally in this case, it owes inflation adjusting dollars for Social Security. What we just said, it's 9% cost of living adjustment. Okay, so the higher inflation goes, the faster that number goes. Secondly, Health and Human Services, the other part of that $3 trillion annual cash out this year, they don't owe dollars for that. They owe healthcare goods and services. That's a foreign currency, so de facto. So it makes this entitlement side of things much more akin to Weimar German war reparations than most investors would care to admit. And that, to me, is sort of the big picture important takeaway. You take a step back. I don't want to get bogged down on, oh, is it 12%, is it 10, is it 8, is it 6? The fact is they are growing faster than GDP. They have been growing faster than GDP. And they are inflation adjusting, basically owed in what is effectively a foreign currency. From BD, thoughts on inflation. Also, I'm irresponsibly long physical gold, silver. If Fed keeps hiking, do I think the metals get beat down? It's been so frustrating because metals can't seem to catch the bid they deserve. I don't know exactly what irresponsibly long physical gold, silver means. I like physical gold and silver a lot. With that said, I would not be irresponsibly long anything right now. If it's your definition of irresponsible might be different than mine, but my definition of irresponsibly long, I wouldn't be irresponsibly long anything right now, even gold, silver. We're in uncharted territory. I want to be overweight gold, silver, physical, but it's important, and I think ultimately it's going to work, but it's a situation where it could not work for a long, long time and then work over a weekend. 30 years of work, 40 years of work, where you get some sort of reset situation. And so I think it's important to have your positions sized in a way that mentally you can survive that, and then financially you can survive that. Because I agree, it has been frustrating, but my position sizing are such that I don't need the money. I have a very strong conviction in how this is going to end up in the end, and I can wait. I'm unlevered. And then the final question from AC. If you have to choose, in what asset would you invest in and hold on to throughout the next 12 months? Having just said how important it is to diversify and how uncomfortable not being overweight and irresponsibly long one era would be. Having said all that, if I had to choose, gun to my head, I would probably want to own energy. I'd probably want to own energy related, and in particular oil. I think that is setting up to be, I think when you look at the combination of the SPR in the U.S. already having run down, shale rolling over, the costs, the increase of inflation in the U.S. shale basins, the difficulty of producing more. And remember, shale's been 90% of global oil production growth over the last 10 years. So it's getting more expensive, harder to produce more. You've got China coming online. And you've got the potential weaponization of oil as well with Russia. So there's a lot of things there that I think are supportive of it. The downside, of course, would be if you get some sort of period of shutdown, economic depression, etc. And that goes right back to my prior point, which is we are in uncharted territory. If anybody tells you, myself included, they know exactly what's going to happen next, take it with a block of salt. For me, like I said, I have strong conviction on how the end game is going to go, but I could draw a lot of different paths with a lot of different implications for a portfolio, and as a result, I want to stay unlevered, diversified, and I do want to stay away from duration, longer dated debt. So. At any rate, that's it for today. As always, thank you very much for joining me. If you enjoy these updates, check us out, FFTT-LLC.com. You can learn more about our tree rings product, 10 most interesting things, and what grabbed our attention about them, whether they're supportive or refuting a way we had previously thought about the world. Otherwise, look forward to catching up with you all soon. Have a great rest of your week. Take care, everybody.